Prateek. Hi, good morning. Great to have you on the show. Prateek, what's happening in West Asia, clearly not under our control, but what is analyzing the earnings. What is it that you've made of the earnings so far?
Earnings are tracking good. Revenues have come in better than expectation. There is some margin pressure, but overall numbers are tracking, I would say, better than expectations.
Hmm. Prateek, just give us the things which have stood out for you in this earnings season.
No, so sectors which were expected to do well have continued to do well. So for example, cable companies, banks, microfinance companies, NBFCs have all delivered very good set of numbers. But more importantly, some of the spaces which were supposed to be headwinded and IT is the flavor of the day. Some names there have surprised positively. So that is adding to the overall slightly positive sentiment coupled with a sharp drop in oil prices.
And Prateek, how do you look at and how do you play IT in an environment like this? There's obviously some bit of uncertainty, but earnings certainly don't seem to have disappointed in meaningful fashion, nor does the commentary really look negative.
No, so IT, there is a different lens for offshore guys. There is a different lens for domestics. We domestics look at rupee earnings, and there the numbers look good. Margins seem to be sustaining. But one has to remember that the margins are what they are after a very sharp rupee depreciation. If you correct for that, had the rupee depreciation not happened, then what would be the margins? Now, the offshore guys are dollar focused, and if they look at dollar growth in revenues and profits, well, in some cases, mid and small, they have come out good, but larger ones have definitely lagged. So our sense is there can be relief. Valuations were cheap. We have been saying this for both banks and IT, which have been in the which have taken it on the chin. Actually, seen very sustained selling pressure. The valuations are cheap, but for a lot of names in the large cap index, growth is subpar. So yes, relief rally can be there, but sustained rally there is not our case. Mid and small things are different.
Right. Prateek, how are you mapping the moves right now and the earnings quality when it comes to the private banking majors? And again, it can't really be an apple-to-apple comparison because each one has its own set of, movers and advantages and even disadvantages, so to speak. But within large cap private banks now, how is it that you're recommending being positioned?
We are not brokers. We are asset managers. We don't recommend. Our portfolios reflect our thoughts. Ex of our large cap funds, we are absent in larger cap private sector bank space in most of our constructs. Valuations may have gotten cheaper versus where they were a few years back, but then growth has also fallen. We see ourselves as growth in earnings focused managers. We work with higher hurdles on growth and, large cap names in banking and IT don't qualify our hurdles. So if you see X of our large cap fund, typically you will find the house not being represented in these spaces.
What I do see is that large exposure to electrical equipments. We've seen that trade play out very well, Prateek. But at the current valuations, what's the call on how much more can investors actually garner out of the entire EMS play?
Yeah, so everything should be seen portfolio. Narrow spaces are very difficult, but will growth sustain here for longer? Our sense is yes. But at the same time, if you see the allocation in our portfolios across the house, you would find our managers keeping the allocations while, like you said, the space has done very well. So on the margin, you would have taken money off the table. And those are the processes that we continuously try and run as possible. There are spaces where growth is offered. We want representation of all of those spaces in our funds. Yes, some space will do well in one period versus the other. You would find us take some profits of that space, put it into spaces which may not have performed by then. So a lot of processes in, and if you see a platter of our funds and see it over last 12 months, which some of these sites show, you will get a lot of processes at work.
Prateek, therefore, what should one at this point of time play? I mean, outside of what we've just spoken about, you're clearly positive with regard to that set of stocks, but you're negative with regard to IT and banks just because of a lack of growth. Where else are the growth spurts coming, according to you?
So I'll tell you one very easy way of thinking about growth is younger businesses. Think of 90s, macro was not good, and we got IT as a space, young, energetic for 10 years, actually 15 years, they continued to deliver superb growth in earnings, and in the process, with all the volatility associated, made huge amount of monies for investors. Now think of it, were digital companies there 10 years back? Were EV companies there even 5 years back, and you get the drift. There are many spaces which are emerging. This is a period of very high disruption. I would say younger spaces, and leadership position in those spaces, and they may be large, mid, small, but leadership positions in those spaces could deliver strong, sustained growth for a long while.
Okay. And therefore, consumption, is that something that you would be skewed towards? And what within consumption? Because we've started to see some bit of growth come in there in certain pockets. Of course, then you've got some of the new age consumption companies, Eternal Swiggy and the like, which are obviously demonstrating very strong growth. Is that what you're really hinting towards?
So we call a lot of it under the digital pack, the tailwind being, we call it value migration, being, brick and mortar to online, okay? And they may be in whichever categories. It could be fintech, it could be, ordering food or whatever. But that is the drift, and you will find that very strongly represented in the portfolio. Except that, if consumption means FMCG, uh, we are close to zero. X of a large cap fund, we are not there for the same reason, doesn't offer the growth, doesn't cross the growth hurdle that we have for our constructs.
Interesting. Okay, that's the take coming in right now on which way some of these sectors are moving. Just wanna, see where the market has settled in at, because it was a little iffy in context with the global weakness and, of course, expiry-led volatility as well, which is bound to play out. But yeah, it's all IT right now. TechM, TCS, Infosys, HCL Technologies, Coforge, which is now up 7%. Emphasis holding out very well. LTM, TechM, they're all the big movers in trade. Not such a great day for BEL, for Godfrey Phillips, or a CG Power or a Power India. That's where you're seeing some of these names actually ebb off as we speak right now. Pradeep, on the contra call really, or rather, the defensive plays, wanted to understand what's your positioning right now around pharma and healthcare?
So in pharma, we are very focused on a narrow space called semaglutide. You see people getting thinner all around us, and it is because they may be taking those drugs, GLP-1s, and you would find most of our constructs have some exposure to hospitals. GLP-1s, we think, will offer very strong growth in earnings for medium to long term. Hospitals, we think, as a category, should do, revenue growth upwards of 15%, leading to profit growth of closer to and beyond 20% for a long while. So, it just crosses our hurdles. So these are the spaces from pharmaceuticals that we have better representation. Some of our funds are represented into CDMO spaces as well.
And Prateek, defense as a pack, it's something which has done again very well. Growth seems to sustain, but it's a mixed bag. Some of the smaller names have very, very strong growth. Where would you bet on where defense is concerned?
Yeah, so defense we should expect would grow faster than most spaces. You would find allocations to defense in the context of what is happening in the world across the world increase versus where it was earlier. And in India, on top of that, you expect more domestic effort. So our companies should end up delivering higher growth. So that is the construct. Now, if you go deeper, there are platform companies, PSUs, okay, we see some fragmentation there. Earlier, platform companies would grow at GDP plus 2-3%. So everybody would give 15 to 20% nominal growth in profit, kind of a targeted number, plus minus 2-3%. Now, if in newer projects you see split, something going to private sector, something going to public sector, this thesis needs to be relooked at. Now, if we look at private sector, the platform companies will never develop one guy. It is in their interest to develop an ecosystem. So for one product, they will have multiple guys, right? Which then means that for some period, one guy may just seem to be very nicely positioned, but in the next period, one more guy would emerge. And that is where the difficulty is. You have to try and find names which do stuff which in some manner is unique. Okay, where there is a degree of IP that is there, and you sell a product rather than provide a service in some sense. So think of that in that light, and I would say going forward, as more focus comes into private sector, at this juncture, at least, the view is that some of these names which are uniquely positioned, not all, some of these names which are uniquely positioned can do much better than public sector platform companies.
Interesting. Prateek, also wanted to understand how is it that you're looking at this entire EV transition that's worked out very well, in two-wheelers. That space has been the fastest to adopt this transition. What next now?
So this is beginning of the story. You would note that in our house we are absent in ICE, zero for us. We are only there in EVs or players who are dominating the space. To us, future is EV, which then means that the valuations which are being ascribed to ICE businesses are very difficult to justify to our mind. If everybody around you says that the next vehicle is going to be EV, well, the market is still giving 15, 20, in some case 30 PE to ICE businesses, which we think very difficult to justify in the mind. So we are there with EV guys only. We think that is the future. We think and it's also a derivative from what is happening in the Gulf. We got an oil shock. People understand if we have to de-risk, EVs is the way out. Some of the Indian guys are doing it very well, so that's fine.
Okay, Prateek, thank you so much for joining us this morning, giving us that perspective. We'll let you go. All right.